How many people do you think have a net worth of $500,000 or more? Is it 5% of Americans? Maybe 20%? Could it be as high as 75%? Ask 10 people and you'll get 10 wildly different answers. Some folks assume only a tiny elite ever reaches that level. Others think half the country must be sitting on $500,000 by now. And honestly, both groups would be shocked by the real number. But here's what makes this even more interesting. The actual percentage doesn't tell you nearly as much as you'd think, because $500,000 in net worth can mean completely different things for different people. For some, it's genuine wealth-building momentum. For others, it's an illusion that makes them feel rich while they're actually stuck in place. The gap between those two realities is massive, and most people have no idea which side they're on. Even more surprising, you could have two neighbors with the exact same $500,000 net worth, and one of them could be on track to become a millionaire in less than a decade, while the other is essentially treading water financially. Same number, completely different futures. Today, we're breaking down exactly who has a $500,000 net worth, what that number is actually made of, and why so many people dramatically overestimate what $500,000 in net worth really means in terms of actual financial power. By the end of this video, you'll understand why net worth alone is one of the most misleading metrics in personal finance. On this channel, I break down the real numbers behind financial freedom, and I help you build wealth that actually works for you instead of just looking good on paper. If that sounds valuable, hit the subscribe button so you don't miss future videos like this.
Let's start with this simplest question. How many households in the United States actually have a net worth of $500,000 or more? According to research from Smart Asset and data from the Federal Reserve's Survey of Consumer Finances, the answer is approximately 29%, nearly 3 out of 10 households. At first glance, that sounds surprisingly high, almost a third of American households hitting the $500,000 mark. But here's what nobody tells you about that 29%. The word household is doing a lot of heavy lifting in that statistic. A household can be a married couple pooling 2 incomes and 2 sets of retirement accounts. It can be a couple with adult children still living at home, combining 3 or even 4 people's assets under one roof. It can even be roommates sharing expenses and splitting rent. When you add up multiple adults' cars, savings accounts, 401ks, and home equity, crossing that $500,000 threshold becomes significantly more attainable than it would be for one person flying solo. Consider this. A married couple where both spouses have modest 401k balances of $75,000 each is already at $150,000 before you even count their home equity, cars, or savings. Add in a $400,000 home with $200,000 paid off, 2 vehicles worth $30,000 combined, and $20,000 in emergency savings, and they're suddenly sitting at $550,000 in total net worth. Neither person is individually wealthy, but together they crossed the $500,000 mark without even maxing out retirement accounts or living in an expensive market. The moment you shift from households to individuals, the picture changes dramatically. When you look at single people, one person's assets minus their debts, the percentage drops to around 15%. Suddenly, that impressive-sounding 29% gets cut nearly in half. And this gap reveals something crucial. Building a $500,000 net worth as a solo person requires either a significantly higher income, more aggressive savings habits, or a longer timeline than building it as part of a dual-income household. Think about what that means. If you're building wealth on your own, you're competing in a much smaller club. Only about 15% of individuals reach that $500,000 net worth milestone. And even among that 15%, the composition of their wealth varies so wildly that comparing them side by side is almost meaningless. But most people don't think about composition. They hear $500,000 and immediately picture someone who's financially comfortable, maybe even wealthy. They imagine a household with $500,000 sitting in investment accounts compounding year after year on a clear path to 7 figures and beyond. That mental image is the default assumption. It's also almost always wrong.
The reality is that most people who have a $500,000 net worth don't have anything close to that amount available to invest, spend, or even access. A huge portion of it, often the majority, is locked inside a single asset, their home. And that's the part that completely changes everything, because home equity and investment portfolios might both count toward net worth, but they behave nothing alike. One grows slowly and sits there. The other compounds aggressively and generates real financial momentum. One requires you to sell your house or take on new debt to access. The other is liquid and working for you every single day the market is open. But here's what nobody tells you. Most Americans with a $500,000 net worth are sitting on the slow, locked version, and many of them have no idea how different their situation is from someone with the same net worth but a completely different asset mix. Write this down. Net worth is not the same as financial power. That distinction is everything, and we're about to break down exactly why. To understand why $500,000 in net worth can mean such different things, we need to talk about what net worth actually measures. Net worth is the total value of everything you own: your home, your car, your retirement accounts, your savings, even your furniture and personal belongings, minus everything you owe. It's a snapshot of your balance sheet. But here's the critical part. Net worth is not a measure of liquidity. It's not telling you how much money you have available if you suddenly needed cash. It's not measuring your financial flexibility or your ability to generate passive income. It's just a number on paper that tells you what would theoretically be left if you sold absolutely everything and paid off every dollar of debt. That's a huge distinction that most people completely miss. You could have a $500,000 net worth and still be unable to come up with $10,000 in cash for an emergency without taking on debt. You could be worth $500,000 on paper and still be living paycheck to paycheck because your income is tied up in fixed expenses and your assets are illiquid. The number looks impressive, but it doesn't necessarily translate to financial security or freedom in your day-to-day life. This is why financial advisors always say net worth is just one metric among many. It's a useful benchmark for tracking long-term progress, but it doesn't tell you anything about cash flow, debt servicing costs, or how much passive income your assets are generating. Because of that, net worth tends to grow fastest in people who bought homes early or bought in expensive real estate markets. And this is where things get really interesting. In many states where home prices have surged over the last 2 decades, the majority of household net worth comes directly from home equity. Look at Hawaii. Roughly 70% of the average household's wealth in Hawaii is tied up in home equity. Massachusetts is similar. More than half of household net worth in Massachusetts comes from the house. Even in states with more affordable real estate, home equity typically makes up around 40 to 50% of total household wealth. So when you hear that 29% of households have a $500,000 net worth, the vast majority of them got there not because they systematically built up $500,000 in retirement accounts or investment portfolios, but because home prices climbed while they paid down a mortgage. This is what makes the $500,000 figure so incredibly misleading. When people hear $500,000, they picture someone with a brokerage account that could realistically grow to $1 million in about 7 years just by sitting in an S&P 500 index fund. They imagine cash flow, stability, financial strength, and options. But most Americans with a $500,000 net worth don't have anywhere near that level of flexibility. They don't have a bunch of money working for them in the background. They have a home that increased in value. And here's the key. That home equity is incredibly difficult to access without either selling the house and moving or taking on new debt through a home equity line of credit or cash out refinance. That distinction between wealth on paper and usable financial power is everything. Let me ask you directly, if you had to choose between $500,000 in home equity or $500,000 in a diversified investment portfolio, which would you pick? Most people instinctively know the answer, but they don't realize how many Americans are stuck with the first option, whether they chose it or not. We're halfway through this video, and if you're still watching, you're already ahead of most people when it comes to understanding how wealth actually works. The next section is where we show you exactly why 2 people with the same net worth can have completely different financial futures. Stay with me. To see why composition matters so much more than the total, picture 2 different people who each have a $500,000 net worth. Person A owns a home worth $750,000 with $300,000 remaining on the mortgage. That gives them $450,000 in home equity. The remaining $50,000 of their net worth is split between a modest retirement account, a little bit of savings, and their car. Person B rents an apartment but has $500,000 entirely in investments, split between index funds, retirement accounts, and a brokerage account. Both of these people show the exact same net worth on paper, $500,000, but their financial trajectories are nothing alike. Person B's $500,000 is working every second the market is open. It's compounding, it's producing returns, it's generating passive income through dividends and capital appreciation. Without lifting a finger, that money could realistically double in less than a decade if it's invested in a typical growth portfolio. Historically, the S&P 500 has averaged around 10% annual returns. At that rate, $500,000 becomes $1 million in roughly 7 to 8 years. Person B is on a path to genuine wealth-building momentum. Their net worth isn't just a number, it's a machine that's actively working in the background. Person A's home equity builds far more slowly. Real estate typically appreciates around 3 to 4% per year on average. Some markets do better, some do worse, but that's the long-term historical trend. And here's what most people miss. The return on equity actually declines over time as the mortgage gets paid down and equity increases. Early on, when someone has a small amount of equity and a large mortgage, a modest increase in home value can create a big percentage gain on their equity. But once that equity grows, each year's appreciation is spread across a much larger base, bringing the effective return rate way down. It's like a balloon that inflates steadily but doesn't multiply. And there's another layer. Person A can't easily access that $450,000 in home equity without selling their house and moving or taking on new debt. If they use a home equity line of credit, they're borrowing against their house and paying interest. If they do a cash-out refinance, they're resetting their mortgage and extending the timeline to being debt-free. Meanwhile, Person B can access their money whenever they want. They can rebalance. They can take advantage of new opportunities. They can live off the dividends if they structure it right. They have flexibility and liquidity. Person A has a nice house and a big number on their net worth statement, but very little financial maneuverability. Pause for a second and think about which profile describes most people you know who have a $500,000 net worth. Chances are it's Person A, the homeowner with most of their wealth locked in real estate. And that's not a criticism of home ownership. Owning a home offers stability. It forces people to save through mortgage payments. It provides a place to live without worrying about rent increases. For many families, home ownership is the single most effective wealth-building tool they'll ever use, simply because it automates savings and provides forced equity accumulation. But it shouldn't be confused with liquid financial strength or aggressive wealth building. Being worth $500,000 on paper is not remotely the same as having $500,000 that can work for you, support you, or grow into something much bigger.
Here's where things get even more complicated. Age plays a massive role in what a $500,000 net worth actually means. A 35-year-old hitting $500,000 is in a phenomenal position. They have time on their side. If that money is invested and they keep contributing, they're likely on track to retire with several $1 million. Compound growth over 20 or 30 years is incredibly powerful. Even modest annual contributions can turn $500,000 into $2 million or more by the time they hit their 60s. Time is the most valuable asset in wealth building, and someone reaching $500,000 in their 30s has decades for that advantage to work in their favor. But someone nearing retirement with $500,000 may actually be far behind where they need to be, especially if the majority of that net worth is tied up in home equity. The compounding window is closing. They don't have 30 years. They might only have 5 or 10 years before they need to start withdrawing from their accounts to supplement Social Security. According to recent data, the median retirement savings for Americans aged 55 to 64 is just around $200,000. The median net worth for people in that same age range is roughly $365,000 to $410,000, depending on the survey. That means someone in their late 50s or early 60s with a $500,000 net worth isn't actually that far ahead of the median. They're doing better than average, sure, but they're not sitting on some massive financial cushion. And if $400,000 of that $500,000 is locked in their house, their liquid investable assets might only be around $100,000. That's not enough to generate meaningful passive income in retirement. At a 4% safe withdrawal rate, $100,000 gives you $4,000 per year. That's $333 per month. Nobody is retiring comfortably on that. This is why understanding where wealth is stored is just as important as knowing the total. A retiree with $500,000 in net worth, but only $100,000 in retirement accounts is in a fundamentally different situation than a retiree with $500,000 fully invested. The first person is going to rely heavily on Social Security and might need to downsize their home eventually to unlock some of that equity. The second person has options. They can live off their portfolio. They can let it keep growing. They can pass it on to their kids. The net worth number is identical, but the financial freedom gap is enormous. And there's another issue people rarely think about. Hitting $500,000 creates this psychological illusion that the next milestone, $1 million, is basically guaranteed, and that can absolutely be true, but only under the right conditions. If someone has the full $500,000 sitting in an S&P 500 index fund, the math is on their side. Historically, even average market returns will push that balance to $1 million in less than 10 years. But if most of that $500,000 is locked inside a home that appreciates at 3% annually, it's going to take much, much longer. Real estate appreciation alone won't double your net worth in a decade. It might not even get you halfway there. Would you bet your retirement timeline on 3% annual home appreciation, or would you rather have your money compounding at 10% in the market? The answer is obvious, but millions of Americans are unknowingly locked into the slower path simply because they never diversified beyond home equity. And that brings us to the final piece of this puzzle. In the next 2 minutes, I'll show you exactly why the composition of your net worth matters infinitely more than the total. We've already established that 29% of households have a net worth of $500,000 or more. We've shown that only 15% of individuals reach that level. We've broken down how most of that wealth is locked in home equity rather than liquid investments. We've explained why two people with identical net worth numbers can have completely different financial futures. But here's the final insight that ties it all together. Net worth is a lagging indicator. It tells you where you've been, not where you're going. A high net worth built primarily on home equity means you successfully paid down a mortgage while your property appreciated. That's great. It's an accomplishment. But it doesn't predict your next decade of wealth building the way a high net worth built on investments does. Home equity grows linearly and slowly. Investments grow exponentially through compounding. The difference in trajectory is staggering. Think about what $500,000 looks like for a typical American household today. They might have $350,000 in home equity, $100,000 in retirement accounts, and the remaining $50,000 spread across savings, cars, and personal property. That's a solid foundation. It's more than most people have. But the liquid portion, the part that's actually generating compound growth and passive income, is just $100,000. That's the number that determines their financial freedom timeline, not the $500,000 headline figure. Now imagine a different household with the same $500,000 net worth, but structured completely differently. They rent, so they have zero home equity, but they have $400,000 in index funds and retirement accounts, plus $100,000 in cash reserves. This household has the same net worth, but they're in an entirely different wealth building phase. Their $400,000 in investments is compounding. At historical market returns, it could hit $800,000 in 7 years without them adding another dollar. Meanwhile, the first household's home equity might grow from $350,000 to $400,000 over that same period. Both households started at $500,000. 7 years later, one is approaching $1 million in liquid investments. The other is still mostly locked in their house. So what does this mean for you? If you're building toward that $500,000 net worth milestone, pay very close attention to where your wealth is accumulating. Home equity is valuable. It provides stability and forces you to save, but it shouldn't be the majority of your net worth if you want genuine financial freedom and aggressive wealth building. Once you have a solid emergency fund and you're contributing enough to get any employer 401k match
Every extra dollar you can invest in the market is a dollar that's working for you at a much higher rate than home equity ever will. And if you're already at or above $500,000 in net worth, take an honest look at the breakdown. What percentage is in your home? What percentage is in retirement accounts and taxable investment accounts? What percentage is generating passive income right now? Those questions reveal far more about your financial strength than the net worth number itself. The wealthy understand this instinctively. They don't just accumulate assets, they accumulate the right kind of assets, the kind that compound, generate income, and provide liquidity. That's the difference between looking rich on paper and actually building wealth that changes your life. What percentage of your net worth is actively working for you right now versus just sitting there, locked in an asset you can't easily access? That's the question worth asking. Because once you shift your focus from total net worth to investable net worth, everything changes.